Notes receivable is another receivable, different from accounts receivable, which is an informal credit arrangement. Notes receivable is a formal credit arrangement. It represents a transaction between a creditor and a debtor, or the lender and the borrowers. Depends on the note's duration. The notes receivable can be classified as short-term note, long-term note. For example, if the note will be due within 6 months, this note receivable will be recorded in the current assets. If it is longer than 1 year, the note receivable should be recorded as non-current assets. So the note receivable, if it is from the sales, the creditor actually is the seller. It is also the creditor. So there's dual identity of the business, the seller. It sells goods to the customer while provide credit to the customer in the form of notes receivable. For the notes receivable cases, the business who sell goods to the customer will recognize sales revenue, and also it play a role as a lender. So it also will recognize interest revenue in the future. And interest calculation is using this formula. Let's take a look at this example. This company on May 1st, 2024 sold goods to the customer, and it agreed to accept a note, $700,000, 6 months, state rate 12%. It means starting from May 1st, in 6 months or 6 months later, the customer should pay $600,000 back, plus the interest, because this is the example of interest-bearing notes. Since it is 6 months, so the sales and the notes received may happen in 1 year. So this is what the example here. On May 1st, after 6 months, that was November 1st. So these two transactions occurred within 1 year. So how to make the journal entry? First, the company will recognize, the seller will recognize a notes receivable and sales revenue $700,000. And notes receivable represents the seller provide credit to the customer. Okay, after 6 months, this company received the payments, $742,000. Why it is higher? Because it includes the original principal, $700,000, same as this one, plus interest. The interest was calculated using this formula. $700,000 multiply annual rate. This is half-year interest. So half-year interest is $42,000. So the customer make the payments on November 1st for $742,000. It includes the principal plus the 6 months interest. So for the seller, it recognizes the interest revenue. So these two journal entry also shows us the seller, this wholesale shoe company, make money from the sales of goods and also make money from these lending activities. So that's what I said. This company play a dual role. One is the seller of goods. The other is creditor. But sometimes these two transactions may not happen in 1 year. The journal entry will be a little bit different because the company need to close their book by the end of 2024. So if the transaction occurred on August 1st, 6 months later will be on February 1st, 2025. Again, on August 1st, the company will make this journal entry, same as this one. So you are going to debit notes receivable, $700,000, credit sales revenue, $700,000 on August 1st. So I don't repeat the journal entry in this PowerPoint. But by the end of December 31st, 2024, that's actually 5 months after August 1st. when the sales occurred. You can count August 1st to August 31st, that's 1 month. September, October, November, December, 5 months. So by the end of this year, the seller also, as a lender, should recognize 5 months interest revenue. So this is calculation for 5 months interest revenue. This is also an adjusting entry to accrue this interest revenue, $35,000. And the payment will be made next year on February 1st. So right now, on December 31st, the company recognized an interest receivable. Next year, on February 1st, when this note is due, we'll see the borrower or the customer make the same amount payment as this one. Okay, but this amount is paid the principal with credit and notes receivable to pay the interest receivable here was recognized in 2024, and the last month's interest revenue earned in 2025. On February 1st, that's 1 month from January 1st. So in summary, there's another receivable, also trade receivable, but this receivable is a formal credit arrangement. And the seller, the company, acts the role as the seller and a creditor. So the company can make money from both sales and interest revenue.